Okay, thank you for joining me. My name is Dan Maga. American College Funding is the name of my company. As a little background, I started the business with my father back in 2004. So about 20 years ago, he's since retired. So it's just me in the practice. And I work with parents like yourselves in determining how they're going to pay for their kids' college education. So anything and everything related to working with mom and dad on the financial side of how they're going to pay for college, although I'm not working with the students in terms of essays, admissions, or that part of the process. Now, as I'm going through tonight, if anybody has any questions, please feel free to post them in the Q&A. And then when we get done, if anyone would prefer to ask a live question, I'll give you that option as well. But if there's anything that I say that's confusing or you're not sure about something, don't hesitate to post any questions in the Q&A, and I'll try and get to as many as I can as I'm going through here. So I like to call this how to become an informed buyer of college, or college and retirement. You can do both. Ideally, anything I can help you save on your kid's college education can be redirected for your own retirement. And I like to get started with a little quiz. What percent of incoming freshmen will graduate from that same school with a 4-year degree? And according to US News and World Report, only 41%. Only 19% at most public universities, or 36% at the state's flagship university, or U of I in our example in Illinois. So obviously, anything we can do to help our kids get done in 4 years or maybe even less is only going to reduce the financial burden for mom and dad. And as you know, the cost is skyrocketing. And when I talk about the cost of college, it's not just the tuition, it's the tuition, fees, room and board. And school also build in the additional expenses for books, travel, and miscellaneous. And when you look at the cost of attendance today at the low end in Illinois, at your Eastern Western Illinois, you're looking at around $25,000 a year or $100,000 over the 4 years. And on the flip side, we've got schools like Northwestern and Vanderbilt that have surpassed $90,000 a year. So you could be anywhere from 100 to 360,000 plus for one 4-year college education based on what the costs are today. And to make matters worse, you got to pay Uncle Sam before you pay for college. Or this is going to be paid with after tax dollars, meaning if you're in the 33% tax bracket, you've actually got to earn $150,000 to have $100,000 left to pay for that 4-year Eastern or Western Illinois education. So a lot of what I'm working with on my clients who are either self-employed or own their own business is showing them a way as to how they could pay for a portion of college on a pre-tax basis. And for people who are either self-employed or have their own business, it is possible that we might be able to pay for a portion of this on a pre-tax basis, depending on the situation. Now, when I'm talking about college and the cost, I like to talk about opportunity cost. Opportunity cost simply means it's not just the value of your dollar today, but what that dollar could be worth to you into the future. Or, and I like to use the rule of 72s for this example, simply meaning if the rule of 72s, if you garner that type of a return, your money will double every 10 years. So it's not just the 100,000 that you're spending today on your kid's Eastern or Western Illinois education. If you're going to live another 40 years, that could be worth $1.6 million to you into retirement. So I think it's critical to realize every dollar that we could potentially save here, whether it's two, five, 10,000, whatever the case may be, it's not just that money or that savings today, but what that savings could grow and be worth to you into the future for your own retirement. And a couple key things to remember. You can't borrow for retirement. No one's going to give you a scholarship for retirement, and you cannot use your child's income for retirement. These are all things that we can do right now to potentially pay for a portion of college. Okay, some keys to success. Educate yourself like you're doing right now. Don't assume anything. Don't assume because your friend said, "Ooh, Alabama's giving out a lot of scholarships," that your kid's going to get a scholarship from Alabama. Or don't assume because your coworker said, don't bother filling out the FAFSA, you're not going to get anything, that you shouldn't fill out the FAFSA. You need to understand your situation as it relates to your student and their grades, test scores, academics, as well as you and your finances, and then the specific schools that your student is targeting. And the reality is that just might be different than your friends, neighbors, and coworkers. Evaluate. Know your student aid index, or SAI, and the college's award history. The SAI is a key term you're going to hear throughout this process. The student aid index is basically the amount of money the school thinks you can afford to pay annually. So the lower that number, more eligibility for need-based grants. But that's only half the picture. The other half is the college's award history, meaning just because you're eligible for a grant or your SAI is below the cost of the school, the college is not obligated to give you one. All colleges meet their institutional aid differently. Generally speaking, the private schools will do a better job of offering grants to those that qualify than the public ones. So you need to understand not only what your SAI is and how it kind of like correlates to the colleges on your students list, but then if it is below the cost of attendance of the school, you also want to understand how much of a grant they're actually going to provide, because again, they're not necessarily obligated. As an example, let's say your student wants to go to Indiana University and your SAI is $38,000 and Indiana cost $58,000. So you've got 20,000 financial aid eligibility in this scenario. Now it's up to Indiana to determine how much of that they want to meet in the form of a grant and a loan. And the last thing you would want to do is assume, oh, they think I can afford 38,000, that's my SAI. Indiana is going to give me a $20,000 grant and then I'll owe the difference. Indiana doesn't offer institutional grants. So even though you qualify for 20,000 in that example, they're still going to stiff you with the full bill. And that's not atypical at these large public universities. They may give the student an academic merit scholarship, but they're not going to dip in and give a need-based grant out of their endowment funds for any kids. So ideally, you want to understand that if you qualify for aid before your kids start applying. And on the flip side, let's say your SAI is 38,000, your kid wants to go to Northwestern and they cost 88,000. You got 50,000 of eligibility. I would expect Northwestern to provide a $50,000 grant in that example or meet 100% of the demonstrated need. So in that example, it could actually be less expensive for the family to send their kid to Northwestern than Indiana. But obviously everyone's situation is different. The key is you need to understand not only your SAI, but then how good or bad of a job the college that your student wants to go to will do in terms of meeting any eligibility with the form of a grant as opposed to a loan. And then once all the facts are known, a college, hopefully a strategy can be put in place to pay for this and preserve as much of your assets as possible. Okay, what I like to call the SMART approach, or the ABCs. First things first, I believe everyone should apply for financial aid. It's free. It can only make money available to you. All it costs you is your time to complete the forms. Become cash flow efficient. Obviously, this is going to be an expensive time. Maybe you're looking at the budget trying to figure out where you can trim a thing or two. Credit opportunities. I'm going to talk a little bit about what loans are available to both you and your students to pay for this. And then the last thing I think you want to do is deplete your assets. Everybody recognize him? Even I qualify for college financial aid. If Bill qualifies, do you think you qualify? Obviously, right? There's only one thing that Bill or his kids have to do to be eligible for the private student signature loan, the parent loan for undergraduate students, or the unsubsidized student Stafford loan. There's only one thing that he and everyone on the webinar has to do to be eligible for that and any financial aid, and that's to complete the infamous FAFSA form. Without submitting the FAFSA, you're not going to be able to get any of the things I've listed on the page here. First and foremost, need-based grants and scholarships, that free money that we all want, can't get it without the FAFSA. Another thing is some schools, like NYU, for example, require the FAFSA to be completed for their academic merit-based scholarships. Federal loans, both the subsidized student Stafford loan, the federal Perkins loans, these are 0% loans in the student's name. Federal work study, that's the student given the opportunity to work, earn some money on campus that could be used for their college expenses. The unsubsidized student Stafford loan, this is currently a 6.5% interest rate loan in the student's name. Private student loan, so that's like going to Sallie Mae, College Avenue, SoFi. Typically, the bank is going to require a FAFSA on file to borrow their money. And then the PLUS loan, or parent loan for undergraduate students. This is another federal loan that was in mom or dad's name. Current interest rate fixed at 9.08%. And then unfortunate things happen, right? Job loss. That's a major high medical expenses, or a couple years ago when COVID hit, right? Let's assume you go back to the spring of 2020 and your kid was committed to going to Northwestern, and in the fall you didn't fill out the FAFSA, you were just going to pay for it. You weren't really that concerned about it. And then COVID hits and you've lost your business or your job. Your situation is a lot different than it was in the fall when your student was applying. So you call up Northwestern, you say, hey, my financial situation has changed. Can you help me out? What do you think the first question the financial aid officer is going to ask you? Did you fill out the FAFSA? If you did, great. Here's our special circumstances form. Please complete this. We'll reevaluate your situation, see if we can make aid available. But if you never fill out the FAFSA in the first place, there's nothing they can do until next year. So I also look at this as like a mini insurance policy. In case something within your situation changes, it allows you to go back to the university and ask for some help. Okay. In terms of how we calculate the SAI, this used to be called the EFC, or expected family contribution. And then starting with the upcoming school year, the 24-25 school year, FAFSA like revamped everything. They came up with a bunch of a new formula, new rules and regs, things of that nature. And then that's when it started converting to this student aid index, or SAI. So the federal methodology is using the FAFSA form. And for schools that only require the FAFSA form, like Illinois, Indiana, Michigan State, Marquette, Loyola, DePaul. And then the institutional formula is a slightly different formula than the federal one, and it's being used by schools that have an additional financial aid form required, called the CSS profile. There's like 200 or so schools that fall into that category. Northwestern, Michigan, Vanderbilt, the Ivy League schools, they would fall into that category. So it's possible, if your kid gets into Illinois and Northwestern, the SAIs could be different at the two schools because they're using two different methodologies. Here's some key difference, or some key changes, I should say, in terms of the old FAFSA EFC calculation and what's new with this new student aid index calculation. Some good news: child support received is now viewed as a parent asset as opposed to untaxed income, which is actually not weighted as heavily in the formula. So if a parent is divorced and they're getting child support from their ex, it's actually better for them than the old formula. What's not so good is, previously, if you had a small business with less than 100 employees, didn't have to report that valuation. Now you do. So I definitely would suggest anyone, contacting me before they fill out this FAFSA form, if you're a business owner or self-employed, to make sure you're doing that correctly and not overvaluing anything and reducing your eligibility. Another big change for divorced families is, previously, if the parents were divorced, they wanted the parent to complete the FAFSA, or as the custodial parent, who the child lived with the majority of the year. Now that's changed, and they want the parent to submit the FAFSA to be the parent who provided a majority of the financial support for that student the preceding year. So this is another area where we can get a little strategic depending on the situation. And if you are divorced, I'd strongly suggest meeting before you fill out any of the stuff to make sure you're doing it all correctly. A major one that they took away is multiple kids in college. Previously, they would divide the EFC by the number of kids in college. So if you had two in college and it was 80,000, 40,000 per student. They're not doing that anymore. So if your SAI is 80,000, it's still 80,000 if you got two or three kids in college. At the federal level, I will say, for those institutional CSS profile schools, most of them are still giving the benefit of the doubt, and they're dividing their SAI by the number of kids in college. So that's your Northwestern and Vanderbilt type schools. If your kid makes $9,400 a year or less, it's not going to affect their financial aid. And parents' asset values are going to be exempt from the formula if their income is less than $60,000 and either they receive federal means testing or they don't file a Schedule A through H on their tax return. Um, Another good one is if you're making 401k or 403b tax deductible retirement account contributions, that untaxed income, so to speak, is not factored in the FAFSA, unlike how it used to be. Although the institutional formula will add that those contributions back in. Another big one was 529 plans. Previously, you would report the total value. So if you had like 4 kids, they all had 529 plans. You had to report the total value on the FAFSA form. Now you only have to report the value for the student that's going to college. So you can technically transfer funds tax-free between beneficiaries, and you're reporting the asset values as of the day you fill out the FAFSA. So it is possible you could transfer money out of the student's 529 into one of the siblings, file the FAFSA, and then be good to go and not have to report that asset. Um, and then the timing of this thing. Previously, we would always do the FAFSA. It would go live on October 1st. This past year, they said they were going to do that, and then realistically, they didn't end up making it available basically until early January. I've heard this year that, or for the upcoming 25-26 school year, that they are going to make it available, but only to select colleges or parents in October 1st, so they can test to make sure it's working. But they're not going to let everyone start filling it out until early December. So again, that was news that was just released. So who knows what's going to happen there. But at least as of today, I think you need to be prepared that you might not be able to do it until early December for the 25-26 form. Here's a quote from Calvin Chaney's book, Paying for College Without Going Broke, that I like to read before I get into the financial aid section. You might think that the families who receive the most aid would be the families with the most need. In fact, this is not necessarily true. The people who receive the most aid are the people who best understand the aid process. And having gone through this the past 20 years, that statement could not be more accurate. So, how do we apply for aid? First things first, whether your kid's going to Oakton or Harvard or anywhere in between, you got to fill out the FAFSA form. If your student is applying to Harvard or North Carolina, Virginia, Stanford, SMU, Tulane, University of Miami, Florida, then you got to do that CSS profile form too. And then, in addition to that, some of these schools can have their own institutional forms or worksheets on top of these two forms that they're going to have you complete. And if the parent is self-employed or has their own business and or they are divorced, it's possible, and the CSS profile is required, they could require what's called the business farm supplement for the business owner and the non-custodial profile form from the non-custodial parent. So again, in terms of how to fill this out when you're divorced, let's say, for example, mom and dad are divorced, neither of them are remarried, and mom is providing majority of that student's financial support. So then mom is the one that's going to complete the FAFSA form. She's not going to report anything on her FAFSA about her ex-husband or the dad, other than any child support or alimony he may be providing. But other than that, his information is not anywhere on this form. If their kid applies to, let's say, Northwestern, and they require the CSS profile and the non-custodial profile, then mom has to fill that out, and then dad has to fill out the non-custodial profile form. And then Northwestern would take into account dad's financial situation when determining the financial aid eligibility. But if the non-custodial profile form is not required by the college, then it's only going to look at one of the parents' finances in that example. And if in that same example, let's say mom was remarried and she's the custodial parent, then on the FAFSA form, she has to report both her income and her husband's or the stepfather. So if the custodial parent is remarried, then that step parent's finances come into play. Okay. In terms of need-based aid, you must qualify for this. Main thing that they're looking at here is your assets, your income, how old you are, how many kids are in your family, and how many kids are in college at the same time. And those are the key factors that determine the SAI. And again, number of children in college, it's only affecting the schools that want that CSS profile. So But you can't just simply say, "Oh, I make over $300,000 a year. I'm not going to fill this out. I'm not going to qualify." Not necessarily true, because you can be making $400,000 a year, and if you've got a couple kids at Tulane and NYU or Northwestern or really high-priced private schools, you could qualify and receive grants. And on the flip side, you can make in, $80,000 a year and have a kid go to Indiana and get nothing. So whether or not you qualify for grants, obviously, yes, it does have to do with your financial situation. But the two key factors that people often overlook is how expensive are the colleges, and what type of schools, or how many kids are in college at the same time. Meaning, if your SAI is $60,000, you're not going to qualify for grants if your kid wants to go to Illinois or Purdue or Iowa or Indiana. But if they're applying to Tulane and University of Miami and Northwestern and Vanderbilt, all of those schools are well beyond 60. So we have to understand how expensive are the schools. And then at those Tulane, University of Miami, Vanderbilt type schools, if you've got multiple kids in college, they divide that SAI by the number of kids. So that's why you can't just simply say, "Oh, I make X amount, I'm not going to qualify." It depends on these other key factors too that people often aren't thinking about. Here's a quick little example. Let's say you've got a $75,000 cost school, your SAI is 58,000. That tells the school you have $17,000 financial need. If, for example, let's say the student had a or received a $2,000 scholarship from the high school, and the college required that they report any private or third party scholarships, they then adjust the need down to 15,000. Meaning, if you qualify for grants and if the school your kid's going to requires that you report outside scholarships, it may not do you any good to look for them, because then they're just going to reduce the amount they were going to give you anyway. Now, if the school doesn't require you report the scholarships, or you don't qualify for grants, then any outside scholarships that you bring to the table, or private based scholarships, would simply reduce your out of pocket. So that's something all schools deal with differently. Okay, in terms of the FAFSA, here's kind of some key errors that I see people making. One, don't include retirement account. On the FAFSA, you do not have to include your retirement accounts or your home equity anywhere on the FAFSA. As well as I talked about this earlier, the 529 plan on the FAFSA is only for the student that's going to college, and only if the parent who's filling out the FAFSA owns it. Meaning, if a grandparent owns a 529, you don't have to report that. Or if the parents are divorced and the non-custodial parent who's not on the FAFSA owns the 529, wouldn't have to report that either. Um, and obviously, you don't want to miss any deadlines here. And again, with the FAFSA being in such flux because it's just not working, and it didn't last year, and I'm sure it's going to be a mess this year. You'll definitely want to find out, especially once they formally announce when it's going to be available, when it's due for the school that you're going to. And every school can have a different deadline. And as I touched on earlier, whatever your SAI number is, don't just assume that's what's you're going to pay for college. It could be more or less than that, depending on a whole bunch of other factors. So, in terms of the FAFSA form, um, the main thing I just talked about that's key is there when it asks you what is the current net worth of your investments, you have to read the fine print and realize that you do not have to report the home you live in or any retirement account values, IRAs, 401ks, annuities, cash value, life insurance. None of that has to go anywhere on the FAFSA form. And you're going to be reporting those values as of the day you fill out the form. So again, like I talked about with the 529, if you transferred money from one kid to the other and then filled out the form, you could help reduce your SAI and garner more grants from the colleges. For these CSS profile schools, the main difference between it and the FAFSA in terms of the calculation is they are going to look at your home equity. So they're going to ask you, what year did you buy your house? What is it worth? What year did you buy your house? What did you pay for it? What is it worth today? And what is the mortgage balance? And the difference between the value that you estimate and the mortgage balance for that equity, they're going to factor into the formula just like it's cash in your checking account. So If you have the unfortunate responsibility of filling out this form, don't try and overvalue your home and impress them and just inflate an asset that they're going to think you can tap into to pay for college. Um, this form is a lot more detailed, a lot more intense in the FAFSA, a lot more questions, a lot more time consuming. And unfortunately, it's not free. They actually charge you to fill it out. Um, but one of the good news here is, like I said, most of the schools that use this, if you have multiple kids in college, they do give you the benefit of dividing that SAI by the two kids. Um, in terms of the timing of this, you start to fill this out like in the fall, winter of the student's senior year. Now, for the FAFSA, in order to be able to submit it, both the student and one of the parents is going to have to create what's called an FSA ID. That's going to be like the electronic signature to submit this form. And when you create the ID, it does have to get processed through Social Security Administration. So you can go on and create that now so that when the FAFSA opens up in a few months, the IDs are ready to go. Um, and be sure to understand the instructions and how you're completing this. And you are doing this every year for every kid. You know, just like your situation can change every year, you have to refile the FAFSA every year. So if you've got two kids, hopefully they both graduate in 4 years, you're filling out 8 FAFSAs over the time period. So not just the first year, you have to fill it out every year. Now, although the assets, when you complete the form or as of the day you fill it out, income is a little bit different. They're going to be looking 2 years back. So if you've got a 2025 grad who's going into their senior year here in, a couple of weeks, whatever, um, when you're applying for aid for them for their freshman year, it's going to be assets as of the day you fill out the form, income from 2023. So they're looking 2 years back for income, day you fill out the form for the asset values. And um, like everything else, you're going to do all this stuff online. Um, Obviously, you're going to submit the FAFSA to all the schools. The CSS is only for a select number, so you'll have to see if that's required. And then a lot of schools are going to want to see copies of tax returns. You're going to want to be prepared to send that in, as well as if the school has additional forms or verification worksheets that they can require, like on a case-to-case basis, you'll want to be sure to complete those too if they're required. Um, so let's assume at this point your senior has submitted the application, you've filed for financial aid, and now we're fast forward into the winter and spring, and you're going to start getting the award letters from the schools who've accepted your student. The award letter is going to detail everything from a cost perspective, from what they're charging you, tuition, fees, room and board, books, travel, to what they're going to offer, grants, scholarships, loans. So you can compare and contrast the different offers and see how they compare before your student commits to where they're going to go, which is typically May 1st. Um, if you don't apply for financial aid, you will not receive an award letter. And if your student is not admitted, same thing, won't receive an award letter um, if if the student's never accepted to the school. So, but again, if they're admitted, you apply for aid, you're going to get an award letter from every school before they commit to where they're going to go. Here's a couple examples. So here's an example. This is for Indiana from a couple years ago. Um, you can see Indiana was a little under $56,000 at the time. This student received a $10,000 academic merit scholarship and a $5,500 federal student loan. So the net cost for this family to send their kid to Indiana was $40,240 for the freshman year after that scholarship and federal student loan. The same student was accepted to Wash U, far more expensive than Indiana. You can see over 83,000 at the time. But you'll also notice that they were far more giving. They gave a grant of almost $47,000. So after the grant and the same $5,500 loan, it was actually less than 29,000 to send their student to Wash U for their freshman year. Over, a $12,000 difference between them and Indiana. So even though Indiana was significantly less expensive from a sticker price standpoint on paper, it was actually more expensive for this family to send their kid to Indiana compared to Wash U. And this is not atypical depending on the situation. You may not necessarily want to rule out these higher priced private schools depending on your situation if more grants and scholarships are going to be offered by them to reduce the price tag. And I'll give you one guess for that kid's Going to school will wash you, right? Okay. What would it be worth to know how to save 33,000 on any 4-year college your child chooses? So this is how mom and dad can save 33,000 per kid. Most kids get off about 15 weeks during the summer. If we can convince our kids to work, earn, save 100 bucks a week, that's 1,500 a year or 6,000 over the 4 years of money that they're not calling home asking for from mom and dad. Money that they're, for their spending money, so to speak. Um, every student's eligible for the federal student loan. You, me, Bill Gates, everybody in between, like I talked about, as long as you submit the FAFSA, this loan's available across the board. The max that the student can borrow is 27,000 over the 4 years, 5,500 the freshman year, 6,500 the sophomore year, 7,500 the junior and senior year. They have to start repaying the loan 6 months after they graduate. If they go on to graduate school, they can defer that until after graduate school. The typical repayment is a 10-year amortized loan. So principal and interest, majority of the interest is upfront, more principal on the back end. The interest is tax deductible to the student, and there's no prepayment penalty on the loans. You could always pay it off early if you wanted to. The unsubsidized loan carries a 6.5% interest rate, and the subsidized loan is 0% during college. So the next question, how do I get the subsidized loan? If your SAI is below the cost of the college, or you qualify for financial aid, the school can subsidize the loan. If your SAI is above the cost of attendance, then the student can still get the loan. It would just all be unsubsidized. So, and of the numbers you see on the page, the max that you can get subsidized is all but $2,000 a year. So a freshman can get a $3,500 subsidized loan and a $2,000 unsubsidized loan. And then sophomore, $4,500 and $2,000. Junior, senior, $5,500 and $2,000. So Bill Gates's kid can borrow $5,500 at 6.5%. And then a student with financial aid can also borrow $5,500. It's just they'd have a $3,500 0% loan and then a $2,000 6% loan. Every year, the Fed will announce a new fixed interest rate based on where rates, prime and interest rates are. So as you can imagine, the rates are kind of as high as they've been. And I mean, quite honestly, I think they're as high as they've ever been since I've been doing this. A couple of years ago, they were like 3-4%. So obviously, it depends on where rates are in the world to determine what that rate is. But every summer, the Fed will announce it before the school year starts. So another thing that I'll point out is, this is not a lot of money, right? We talked about what these schools are charging, 27,000. It's not even 10% of what some of these schools are charging. So, but that's all your kids can get. Don't let your kids say, mom, dad, I want to go to Michigan, not Illinois. Don't worry, I'll borrow the extra 120,000. Because the reality is, no one's going to loan it to them. Now they'll loan you the money, or they'll loan your kid the money if you co-sign on their loan. But private banks aren't loaning 17 and 18-year-old kids money to get their undergrad degrees. They'll do it for graduate school. The kids can borrow on their own federal loans, but for undergrad, for better or worse, $5,500 is the most they can get as a freshman. The rest somehow falls on mom and dad, either through their loans or private loans that they would co-sign for the student to get it approved. So in terms of using this to your advantage, obviously, if the kid takes on the loan and repays it, saves you the 27,000. But maybe you don't want your kids to have debt, or you don't want them to have student loans. Maybe you tell them, hey, this is your skin in the game, financial responsibility. Mom and dad are going to cover this amount. This is on you. And then you have them take on the loan. Then you decide when they're done, do you want to help them with it or not? Or maybe you say, look, if the government's going to loan me money at 0%, I'm going to take it. I'm going to keep my money invested over here. And I'll just pay off the loan 4 years later when my kids graduate. So I think there's a number of ways you can use this to your advantage. The only key thing to remember is the only thing you have to do to have it available is submit the FAFSA form. As long as you do that, this option will be available to your student every year. Okay, some myths versus reality. Oh, I'm not going to apply for aid. I make too much money. Hopefully I've dispelled that, right? Through all the reasons, all the benefits that you get for applying for aid, even if you don't technically qualify. Or I'm not going to qualify. I got $1 million house that's paid off. They're never going to think I qualify for aid. Like I said, FAFSA form, you don't report the equity in your home. Um, oh, I got a lot of debt. I got credit card debt. I owe money to the IRS. I got car loans. They're going to look at me more favorably. No, nowhere on the FAFSA are you reporting your debts. It's all about your assets and your income. So the debts aren't going to have any positive effect on how much they think you can afford to pay. Getting financial aid is easy. Look, the whole reason they revamped this whole thing, this past year was to make it easier for people to fill it out. Now, did it do that in my opinion? No. Millions and millions of people, less than before, filled this out because it's even more confusing than it was before. Um, Now, by no means am I saying I'm the only person that can submit a FAFSA, but depending on your situation, depending on the type of person you are, good with numbers, forms, that sort of thing, um, it can be a very arduous, difficult process for sure. Um, this is a good one. Student will get more aid if independent. There was an advisor in the western suburbs years ago who was advising her clients to relinquish guardianship of her kids so could be considered independent for financial aid purposes. Now, as you can imagine, when the colleges figure this out, they're wise to the fact that if you say that your kids in guardianship, they're going to ask for a lot of documentation to prove that that's a realistic situation. So the reality is getting your student to qualify as an independent is pretty difficult, and I would say atypical for most of our kids. A couple examples of how they would be considered independent would be if they're over 24 years old, if they're pursuing a graduate degree, they've been honorably discharged from the service, if both parents are deceased, if guardianship. But you can't just take your kid off your tax return and then say they're independent. It's not that easy. But obviously it is possible you could have that situation. If you Google FAFSA dependency questions, you can kind of see what that entails in terms of how you qualify. And if you did qualify as an independent student, the benefit is you don't have to list the parents' information on the FAFSA form. It would just be the student's information. So obviously they could be more eligible. Or my son, he didn't do great on the ACT. No one's going to give this kid a scholarship. Not necessarily true. I don't care what your kid's grades or test score is. There is a school out there that will give them a scholarship. The reason I know that is there are schools out there that give every student a scholarship. You just have to figure out where your student's grades and scores kind of align at the top of that school's incoming class. Now, don't come to me with a kid who has a 19 ACT score and expect me to tell you that they're going to get a scholarship from UCLA. That's just not realistic. But there are schools that will, and we've just got to find them. And the good news is I can help you understand the scholarship amounts that your kids are going to receive from the schools before they apply. So if we're trying to target certain schools within a certain budget, help you understand what money is available to your student based on their grades and scores and the colleges that they're targeting. And the great thing about academic merit scholarships is they're fixed over the 4 years. So you know you're going to get it every year. And you also know that it has nothing to do with your finances. So if you don't qualify for financial aid, that's going to have no effect on your student having the ability to receive an academic merit scholarship. And I keep detailed records of all my clients and all the money they're receiving so that when my new clients are coming in, I'm able to show them, hey, here's what I would expect your student to receive before they apply here in the next few weeks. All right, so here's a little case study. So this is a client that came to me a couple of years ago who had two kids. They were back-to-back school years. The first student was just starting at Illinois, and then they had a freshman in Illinois, and then the senior wanted to go to Northwestern. They had saved some money for college, but not enough to cover a Northwestern type cost school. But they'd said, look, if our kid gets in, we'll figure it out. We'll send them there no matter what. So even though they couldn't tactically afford it, they were on the belief that, okay, if our kid can get into Northwestern, we'll somehow, some way figure out how to make it happen. So here's a quick little summary of their situation. Their income was $275,000 a year. They had $100,000 saved for college, $750,000 in retirement, $50,000 savings account. They had a $300,000 mortgage on their home. They owed $25,000 on a PLUS loan, which was the loan they'd used to cover the first year at Illinois because they didn't know how to do it. They owed 30,000 on a car, and they felt they could afford about 1,000 a month out of their income or their cash flow without negatively affecting their lifestyle. Um, so the good news is they'd save money and they could afford some out of their income, but it wasn't going to be enough to cover Northwestern and Illinois. So what they have to do? They had to borrow the money. Now, at the time, because the rates were so great, I suggested they borrow the money out of their home. Reason being, it was the lowest interest rate. It gave them the tax deduction and allowed them to defer the payment or reduce the monthly payment. So, in this example, they took out a new loan on the home. They paid off some old debts, and then they had $100,000 of tax-free capital that they could now use to pay for Illinois and Northwestern when their funds ran out. Please understand, had the second student decided to go to Illinois, there would have been no reason to refinance the home or borrow more money. They had enough to cover it, but they didn't have enough to cover Illinois Northwestern, and they'd agreed to let the kid go there if they got in. And of course, the kid got in, and they had to come up with the money somehow, some way. The other benefit to getting ahead of the game and planning beforehand is I was able to help reduce their student aid index number to garner more grants from Northwestern. Now, reducing the SAI didn't have a positive effect at Illinois, who doesn't typically provide grants, but at Northwestern, going from 60,000 down to 45,000, or a reduction of 15,000 a year, that's an extra $15,000 a year in real grants, real money. So, understanding how to reduce this number, this SAI number, if possible, at some schools is literally going to translate to extra grants dollar for dollar. And then here's what a summary of what the costs look like, the financial aid offers look like. So at Northwestern, the cost was 80,000. They were receiving a grant of about 35,000, and then they had a federal student loan. They had that 50,000 saved for each kid. So we just divided that over the 4 years. The kid was working a little bit. The parent was kicking in $1,000 a month out of their income between the two kids. And then for Northwestern and Illinois, they were about $30,000 short. And again, in Illinois, there were no grants or anything like that. It was just the federal student loan. So that 30,000 shortfall, that's what they dipped into the 100,000 that they had taken out of the home to kind of make ends meet and pay for this. Perfectly legal and ethical to do all this. It's just understanding how this convoluted system works and then kind of like how you fit into the system. And if there's anything we can do to increase the amount of grants and scholarships that your kids are going to receive to then reduce your net cost, I want to help you understand how to do that, because then it's going to be that much easier to figure out how to pay for this thing. Okay, in terms of next steps, at this point, I don't know if you need my help or you want my help, but everyone who comes on the webinar, I give them an option to hold a free Zoom consult with me. All I would need you to do prior to that meeting is I'll send everyone tonight a confidential data sheet that I have everyone complete before the meeting, which has basic information on yourself and basic information on your student, grades, test scores, colleges, that sort of thing, and basic finances on yourself. That way, when we meet, I'm going to show you, here's your SAI. And then based on the schools you've listed, here's what I would expect in terms of need-based grants or academic merit scholarships from these specific schools based on your specific situation, so that we know before your kid starts applying here in the next few weeks or months what those costs are going to look like. Because if we're trying to find schools within a certain budget, to me, the biggest mistake you can make is just let your kids apply wherever they want, and then you figure it out in the spring when they get the offers. Because when they get the offers in the spring, now it's too late to apply anywhere else. So if you haven't chosen good options of schools that are going to be helpful, by the time you find that out in March or April, you can't go back and apply. So we kind of need to get that figured out now. So again, during that meeting, I'll be able to help you understand, okay, the grants and scholarships from the schools that your student is targeting, as well as I'm going to come up with some other ideas of schools and say, hey, these are similar to the ones you mentioned, but ones that are going to give a lot more money, just so you kind of know what else is out there. And I'm not going to charge anybody any fees or anything until I've like given this detailed report and gone through everything with them, so they understand, okay, here's where Dan can help me, or maybe here's where Dan cannot help me. So you can kind of gauge from there if it makes sense um, to work together. If at the end of the day you say, yes, Dan, I want you to hire you to handle this for me. I charge $7.95 up front and then $60 a month for 36 months. So $29.55 is the total fee over that time period. And then that covers all the children in the family. So whether you got 2, 3, 4 kids, that fee would cover you for all the kids until the youngest has graduated college. And in terms of the services, the main thing I'm doing is I'm completing all the financial aid forms. So the FAFSA, the profile, any sort of verification works, any sort of financial aid related form, I'm going to complete. Any of the admissions or essays, that would be on the student. I also help in appealing for financial aid. So when we hear how much the colleges are offering in the spring, I'm helping my clients understand, okay, here's how you can go back to the schools if there's ways that we can maybe get more money out of them. And then, you know, it's developing a comprehensive financial plan based on your specific situation to understand, okay, based on all these variables, here's how I would suggest paying for it so that we're doing that in the most efficient manner and we're not leaving any money on the table. As well as I kind of talked about earlier, it's helping your kid now, or if you've got younger kids, before they start applying to schools, understanding what their targets are going to offer in grants and scholarships before they apply, if we're trying to target schools within a certain price point. And then just kind of basically being your consultant over the next, 4, 6, 8, 10 years, whatever it is, to make sure no matter where your kids go, what they pay, we're getting the best deal possible. And you have peace of mind knowing that, you didn't screw anything up, you didn't leave any money on the table, and you didn't have to worry about, the nightmare of filling out all these forms. So I'll send everyone an email tonight at the end of the webinar with the confidential data sheet that you'd need to complete and send back to me prior, a sample report of the type of information I'll provide during that free Zoom consult, and then you can reply to that reply to that email and let me know how you'd like to proceed with scheduling that meeting. So with that being said, that's pretty much it for the webinar. I'm going to go through a couple questions people posted in the Q&A. And obviously, if you have any questions about anything I covered or didn't cover, please, you can either raise your hand, I can unmute you to ask a live question, or you could post it in the Q&A and I can answer it that way. One question, what if the student does not have a tax return? That's okay. It's going to ask you on the FAFSA form, both parent and student, did you file a tax return? And if you didn't file it, you just click no if they didn't file a tax return, and obviously there's nothing to report there. So that's okay. Please include at FAFSA changes for independent students. There's not really any changes per se to the FAFSA for independent students, unlike the formula and stuff that I went through. For the most part, the dependency questions and whether or not you qualify, quite honestly, they stayed exactly the same through this whole transition. So there's not a lot of changes there from a dependent to an independent student, so to speak. And then for the CSS for independent students, that's going to depend on the school. But for the most part, if a CSS profile is required for an independent student, you're going to have to report like the guardian or the parent or the other the adult's information, unlike the FAFSA form that you would just report the kid's information. Any other questions out there, again, from maybe something I didn't cover or something you're confused about? Go ahead, Jerry.
Hey, Dan, thank you very much for the detailed information. I did receive your email about this forms, but I saw there's lots of confidential information. So how do I protect the information I submitted to you?
Yeah, I have a secure upload link that I can provide you. So which is going to be safer than just emailing me the form. So you'll just ask me like, hey, Dan, can you email me a secure link? And then I'll put that in, then you can upload the information that way. Keep in mind for this, on that form, you're not going to have to put social security numbers, account numbers, or anything like. Eventually, if we're working together, I would need socials and stuff, but for the initial meeting, I don't need, any of that type of detailed info.
Okay. And also, I know you are here in Chicago, around Chicago area. So in addition to, besides the Zoom meeting, is there any chance to see like an in-person meeting?
That depends. I mean, it just depends on my schedule. Quite honestly, I used to only meet people in person until COVID, and then um, after COVID, I started working from home, and my office lease ended, and then I basically just been working out of my house since then. I just typically just meet with people over Zoom or phone, but if there's a reason that we would need to meet, you can probably make that happen at like I met with people at Starbucks, stuff like that.
Yes. Okay.
Any other questions out there? Can you talk about options for business owners? That's really tough until we meet, because every business is obviously different. It's hard for me to give any good information because it's so generalized without knowing the details. But like I said, I will say if you're business owners, depending on how the business is structured, if you're incorporated, how many employees, that sort of thing, there can definitely be a lot of things that you can do that the standard employee cannot. And when we meet, I'll be able to walk you through, depending on your business and the situation, like, hey, here's where we might be able to take advantage and things that we should look into to ensure that we're paying for this as efficiently as possible. Um, what does it look like if we are both retired? Do they count our pensions? Yes. To them, it doesn't matter if it's earned income or pension income or interest income, dividend income, capital gain. It's just income to them. So if you're retired and your pension's $100,000 a year, that to them is just the same as you're working and earning $100,000 a year. So obviously what we would try and do is we would limit the taxable income. So if you were making IRA or other taxable withdrawals, I would be, and we think we're going to qualify for grants, I would want to look at ways that we can maybe get other income into your hands without inflating your tax return, which would reduce your eligibility for grants. Any other questions out there?
Dan, can I ask you a question?
Yeah.
This is Jerry again. You mentioned on one of the slides, you talk about, do not have, we don't have to, as a parent, and I have two kids. One is senior, he's going to school, college. So you said that we don't have to report your 401k, for example, and my Roth IRA, for example. So
Mm-hmm.
so on the FAFSA form, do I have to just leave as blank? How do I put numbers in there?
Well, no, it'll just tell you to specifically omit those values. So when it asks, what is the current net worth of your investments, you would not report any IRA or 401k values. But if you had other stocks, bonds, mutual funds, that sort of thing that were outside of a qualified retirement plan, you would have to report those values.
Okay, and then in terms of house, I do have mortgage, I have the fair market value, I have a cost. So what do I report as equity?
Well, remember on the FAFSA, you don't report the home at all, nothing.
Okay, okay,
Now on the
okay.
CSS profile, that's the form where you report the home and you'll report the year you bought it, what you paid for it, what the
Yeah,
mortgage balance is, and then the fair market value. And then those schools will look at that equity.
okay.
But FAFSA, home equity, retirement accounts, none of that goes anywhere on the FAFSA form.
But this goes on CSI, right?
CSS, it does. Now,
Yeah,
both will actually, retirement accounts and the home. So they'll ask you the value of your retirement accounts, but it will not be taken into account into the formula.
okay.
So they ask it, why they ask it and it's not counted, it's beyond me. I don't know. They want to come up with more frivolous questions to ask you, but don't worry. Those values in the retirement accounts will not affect financial aid eligibility.
Okay, and you mentioned about 3 year. If I engage you, right, as a consultant. So my older one is senior. He's going to college, and then my little one is going to college in 2027. So if I engage you for 3 years, so how that will be covered? We cover both of them.
So the payment, the fee is just paid over 3 years, and I do give you a discount if you pay it up front. But either way, the services, I would still be working with you until your last kid graduates. Or in your case, you would have been paid up for probably a couple years then before the second student has graduated college. So it's just a way to pay the fee, but either way, all of the services would be with you until your youngest is done.
Even beyond the 3 years that after we have
Correct.
this month.
Yep.
Okay.
Exactly.
Okay.
Any other questions from anybody out there? Well, if nobody has any other questions, thank you everybody for joining me. Like I said, I'll send everyone an email tonight with the next steps, and then you can reply to that email from there and let me know how you'd like to proceed with scheduling that free Zoom consult. So thank you again, everyone, for attending, and I'll send you some more information shortly, and then you can reply from there as to how you'd like to proceed. So have a great night.
Thank you, Dan. Thank you, Dan.
You're welcome.
Bye.